All right. Thank you, everyone, so much for joining us at Atlas Private Wealth Management this afternoon. We appreciate everyone taking the time to hop on this call, as well as understanding the weather conditions behind making the tough decision to go fully virtual. Our hope is that some of you are joining us safely from home today, and we're happy to see an array of attendees spanning from clients, friends, community members, and peers. This program being offered to you today by Atlas is in partnership with the Ronald McDonald House Charities of the Capital Region. The idea for this program blossomed from a discussion about legacy and what that means to different people. Whether you're on the call to learn more about building or ensuring what your legacy looks like and what that means to you, it's something that most of us already do in some form or fashion. As a fiduciary, we like to be able to share the knowledge that we have to support those efforts. Our team at Atlas became a corporate sponsor with Ronald McDonald House a couple years back, and we are an annual partner this year due to the connection that the house that Love built has with our team members here. A couple housekeeping notes. There's a QR code at the beginning of the presentation, and that will send you directly to our presenter, Christopher Aiello's email, if you have any personal questions that you would like to ask him. There is additionally a QR code at the very end of the presentation. For those of you that are familiar with them, it will bring you directly to a survey to provide feedback to us about how you felt about the presentation and give any indications for future programming. Likewise, once the program has ended, a web browser will appear with that same survey. So if you're not familiar with QR codes, you'll be directed to a survey. Either way, we really appreciate your feedback and are looking forward to hearing your questions throughout today's presentation. And without further ado, I will hand it off to Sue Nigra, Major Gift Officer at Ronald McDonald House of the Capital Region.
Thanks, Lonnie. I appreciate it. And thanks to Atlas for holding this presentation. You know, as many nonprofits, Ronald McDonald House Charities of the Capital Region relies on donors, sponsors, partners like Atlas to support our mission. We found that many donors, of course, will just write a check. Other donors appreciate having different giving options, such as tax-smart donations of appreciated stocks and bonds. And really, just last week, somebody reached out about changing his union pension beneficiary to RMHC of the Capital Region. The bottom line is, whatever charity you're passionate about, the right giving strategies can not only support your financial goals, you can support a cause you truly believe in. So thanks again to Atlas, really a great partner. And I'm going to send it over to Chris Aiello, their Director of Trust and Estate Planning, for the presentation. Chris?
Thanks, Sue, and thanks, Lonnie, and thank you, everyone, for joining us for this was once a in-house presentation / webinar, now a webinar given the weather in upstate New York. So appreciate your time today, and good morning to those on the West Coast. So I'm Chris Aiello, Director of Trust and Estates at Atlas. Before we get going on the presentation, highlights a little verbiage from the important disclaimer side. So Atlas, we are a registered investment advisor. As such, we are a fiduciary. We act in a fiduciary capacity for our clients. For purposes of the presentation today, we're not a fiduciary. This is a informational presentation and educational. So any information will not be deemed as tax or investment advice, and it's not particular to anyone's specific circumstances. So as we got that out of the way, and we do see the QR code. See the QR code up here. So as Lonnie mentioned, I'm not a big QR code guy, but you can apparently scan that with your phone. When you do, you'll get my email, and any questions that you have, you can email those to me. And so we'll see how that works. So in terms of the agenda is not exhaustive. It's a couple of planning strategies that we see employed by our clients. We'll hit it at a fairly high level because we could go into each strategy somewhat ad nauseum for a long time, but we're here just to hit the highlights to show who's on the webinar, what you may be doing or what you can do in terms of your charitable giving strategies. So with that said, let's take a look at the first one, which is a great strategy, which was giving highly appreciated securities to that to the charity. That said, and as Sue said, a lot of people like to give cash. So instinctively, we reach for our checkbook. So many of you, like you make a charitable donation, you get the checkbook out, $25, $50, $100, maybe $500 after that. Am I giving cash? Does that make sense? So we'll see why, cash is good. The charity welcomes that. They can use it for their operations. It's cash, it clears, and if it's not restricted, that's terrific. But are there better ways to use, your assets to donate to charity? And we think looking at securities that you may have. So you own a stock, a bond, a mutual fund. It's in a taxable account somewhere at a brokerage account or a bank. The benefit of that stock that you may have owned for a low cost basis and now has gone up in price over time, you have a embedded long-term gain in that stock. We'll show you the benefit of donating that security and see how the charity benefits and how you, from a tax perspective, benefits over time. And the two components here, again, twofold. By donating that security to the charity, you have the possibility of eliminating capital gains tax on that direct gift. So you're not selling it, and you're not incurring any capital gain. And based on your tax status, if you itemize, you may be able to take that itemized deduction and deduct that as a charitable contribution. Also, by donating directly to the charity versus selling that stock and then donating the net proceeds, you can make a potentially larger contribution to the charity than selling that net. And you see on the bottom of the screen, depending on the type of property donated, you have the ability to take a charitable deduction up to certain adjusted gross income limitations. So with that said, let's take a look at an example of how this may work with our specific options here. And let's take a look at the bottom of the screen and take a look at our assumptions before we get into options 1, 2, and 3. So we have a XYZ stock with a market value of $50,000. Purchased that many years ago at $10,000. So we have a $40,000 capital gain on that stock. This taxpayer/donor is in the 15% gains rate based on the 24% income tax rate. So what are we doing with our donation here? Option 1, that populate. So we're donating $50,000 of cash, writing a check to American Cancer Society, Ronald McDonald House, Habitat for Humanity, whomever that may be, or maybe we are gift splitting between the three. With that $50,000 contribution, we can take a tax deduction of $50,000. So the value of that deduction, and that is based on this individual donor's tax bracket, is $12,000. So for the math challenged like myself, how do we arrive at that $12,000? That's $50,000 times that income tax rate of $24,000. And if my math is correct, knock wood, that's $12,000. So here are total tax savings of $12,000. Pretty simple to donate that cash. Next option would be, in lieu of the $50,000 cash, this donor taxpayer has $50,000 of that low basis XYZ stock with the $40,000 gain they owned at 10. And what happens here? So they go to their brokerage, they sell it. So the $50,000 becomes $44,000. Why? There's a $6,000, let's say, a long-term capital gain they need to set aside to pay that tax. So that 6 comes at, at the 15% tax rate. So on that 40 gain, so the 40 at the 15 equates to 6,000 if I'm good on that. And we have 44,000 net to the charity. The value of that deduction is $10,560, with total tax savings of $4,560. So you see they lose $6,000 by selling themselves versus directly giving to the charity. And let's take a peek at third and preferential option, just donate the stock directly to the charity. $50,000 to the charity, 0 capital gains. Charity receives the stock, they will sell it. Charity will sell for no tax. They are 501c3 tax exempt. They do not pay tax on that sale. And so their value of the deduction is 12. And so we see here, let me click next, if this works. We have 6,000 capital gains on 2 in the red. And as we see, our total valuations here, 12,000 for option 1 cash, 4560 for 2, and 18 for 3. And we say, you know, for those CPA tax repairs in the audience webinar, what's that 18? I put that 18 in there as, in essence, the tax value of deduction is 12, but you're also not paying that $6,000 capital gain, so that, in essence, the tax savings there. So donating appreciated stock, a great way to do that. Many of our clients do that quite a bit. Charities like that, they can accept, I'm saying generally, accept that stock, and a good way to do it. This leads me into a good segue of strategy number 2. So we'll come back to that appreciated securities with a donor advised fund. Because a donor advised fund, you know, what is it? It's really a charitable investment account for the sole purpose of managing donations. So charitable investment account to manage donations. They're one of the fastest growing charitable investment vehicles in the nation, and they work very well for all levels of wealth. That's why these are donor advised funds. They are terrific. So where do you open a donor advised fund and get into somewhat the, excuse me, the mechanics? You can do it at a brokerage account, the likes of, and I'll pick on Fidelity or Schwab. Community foundations have their own donor advised funds, and maybe even the charity. So you can check out any of the above there for the donor advised funds. It can be funded with very little money. Some of the big brokerages, as little as, you know, $50. The costs are low. You can donate cash. You can donate appreciated securities. Again, with some of the large brokerages, you can donate non-publicly traded assets. So non-publicly traded stock, private business interests, oil and gas royalties, crypto, if you go that route. So even real estate. So it really depends on the supporting organization, what you can donate. They typically have minimal administrative costs to donate, and that is one of the good things about those. The tax benefit, if you itemize, is you get an immediate tax benefit for your donation. So if you're someone that itemizes, so if we're single 2023 filer, if it's 13,850 or thereabouts, and 27,700 for married filing joint, 27,700 for 2023. So if I itemize, I can take that itemized deduction by donating to the donor advised fund. So the strategy here is many of us, because in 2017 under the Jobs Act and tax cuts, I probably said that backwards, raised the standard deduction where many taxpayers now don't itemize, and the standard deduction was higher and is higher than what one can itemize, because it also had the SALT limitation in there, $10,000 property tax. So with that said, you can bunch your contribution. So one were to look to donate maybe $30,000 to the donor advised fund over a period of years. In lieu of that, over maybe a span of 3 years, you donate that $30,000 up front, take that itemized deduction. Now the $30,000 is sitting in the donor advised fund, and do you have to have the donor advised fund distribute that charitable contribution, the grant to the charity all at once? No. So you can take that deduction, have it sit in the donor advised fund, depending on the supporting organization, invest that over time, and they will then distribute those funds, that grant to the charity, you know, on your time frame. So the flexibility of the DAF is another great aspect to that. So back to our couple in option 3 with the donor appreciated stock. So they take that $50,000, donate that in that lump sum to the donor advised fund. They're going to receive an immediate deduction this year. That $50,000 can again be distributed out by the donor advised fund, or it can sit there for a period of years and go to their charities of choice. So very flexible administrative ease. The costs are typically low on the donor advised funds. So a great vehicle. Just from those aspects, you can see why it has become very popular. Any questions on that from the group, if I can see those? And if not, you can always email those questions. No questions, I'll move on. From donor advised fund, from the simple administrative ease to the complex. So we'll talk about charitable trust, a charitable lead, and then a charitable remainder trust. And these are very complex, sophisticated, need generally substantial assets to make them work in the favor of you and the beneficiary, whether it's a charity or the non-charitable beneficiary. But they are a strategy, a tool, a technique that works well depending on facts and circumstances. So charitable lead trust is an irrevocable trust that will pay income to the charity or the charities for a certain number of years, a term or over the lives of one or another individual. So they are the lead income beneficiary of that trust. At the end of that term, whatever that term length may be, 5, 10, 15, 20 years, at the end of the term, assets will distribute from that trust, which charity received, which we'll see in an illustration in a moment, and to the beneficiary. So this is for one or anyone who is charitably inclined, has the assets to do so, is looking for estate and gift tax elimination, transfer, or mitigation. There are two types of charitable lead trusts, as we see here. I won't get into the acronyms, a charitable lead unit trust and an annuity trust. The difference of the two is really the payout. One is a fixed annuity, a fixed dollar amount for the term of that trust. The unit trust is a percentage, and that percentage then will change every year on the value of that trust. There are different reasons as to why one would choose an annuity versus a unit, somewhat beyond the scope of this conversation or webinar, but if you have questions on that, I'd be happy to answer. So let's take a look at an illustration on, from a high level on how this works. So we have a donor that is contributing, we'll say $500,000. That could be cash, securities, privately held assets to that trust. So that is our donor on the left. They establish that trust. They fund the trust with those assets. And for purposes of our illustration, we're going to assume it has a growth rate of 7%. And we won't get into the mechanics on how we derive or arrive at growth rates, but for illustrative purposes, we pick 7%. So here we have the charity receiving $25,000, or this could be more than one charity, $25,000 a year for a period of 20 years. So this person was charitably inclined, had enough assets to do so, to put into this trust irrevocably. So once they put it in, generally they cannot take it out, save for some exigent circumstances in the trust document. So charity receives the $25,000 for 20 years. What happens at the end of the term? Based on the growth rate of that 500,000, based on our future value down and dirty calculation, the remainder interest to the non-charitable beneficiary, 909,000 in change to that beneficiary, with a portion of that being free of estate and gift taxes. And that could be a whole day on how that works. But that is the general overview of the charitable lead trust. Need to have substantial assets. It's a cost to establish that, have the trust drafted, and also a cost to administer that trust over time. That leads us to the contra, to the inverse or the opposite of the charitable lead trust would be the charitable remainder trust. So again, as we look here, it says it's a mirror image. So with a charitable remainder trust, we also have it in an annuity form, but here, and also in a unit trust. So this is the exact opposite. So we could take that same $500,000 to fund the trust, but versus the lead trust where the lead beneficiary is the charity, here the charity will receive the assets at the end of the trust term, which can be no more than 20 years. So the charity receives at the end of the trust term, then there are non-charitable income beneficiaries receiving that income during the term that charitable remainder trust. And that is just a very 20,000 feet high level overview, but worked same way as a CLT, but flipped around. Here's the strategy, QCDs, that many of our retired clients that have IRAs use quite often. So this is a terrific planning strategy that has been, in 2015, I think that this became permanent. But what is a qualified charitable distribution? It's a tax planning strategy that allows someone to take a distribution from their IRA account and donate that distribution directly to the charity. So I will pick on Ronald McDonald House for the moment. So I am 75 years old. I have to take a required minimum distribution from my IRA account as mandated by law. And we'll say that's a $40,000 distribution, RMD, that I receive that I have to take out each year. We won't go into details of RMDs. But from that required minimum distribution, I say to myself, you know what, I'd like to give half of that. I don't need the income. I'd like to give half of that to charity. So I can I'll designate out of the 40,000 distribution, 20,000 to go to the charity of my choice. Let's say the brokerage account where I have this IRA, I let them know that I'd like 20,000 to go to Ronald McDonald House, Penn American Cancer Society. We'll split it up. They will write a check to each. I will give them instructions on where to mail it. That check will be mailed from brokerage. I don't touch it. Goes to charity. That $20,000 is, as we see from the next slide, I believe, is excluded from my taxable income. So I don't receive a tax deduction. It is excludable income, which is even better from that IRA. So that $20,000 I never see. It is not income to me. We'll talk about reporting requirements in a moment, but that is that's a great way if you don't need the money coming from the RMD from your IRA to give to charity. And as you see on the first bullet point too, out of that 40,000 that I have to take as required minimum distribution, that 20,000 is part and parcel of that satisfies part of my RMD. So I'm taking that out of my RMD. I don't have to increase my RMD because I gave 20 to charity. That comes out of the 40,000 required RMD. And in terms of tax reporting, it's really a self-reporting mechanism, the QCD. So that would be, not sure on the tax line where that is, but the brokerage account is not reporting that as an RMD. It may on your brokerage statement, but not on the transaction per se. So that has to be self-reported, as you'll see a $40,000 distribution, and the line under that will say qualified charitable distribution, and the service thus far is pretty good on how that works. A couple limitations or qualifications for qualified charitable distribution. So it comes from a traditional IRA, an inherited, a SEP, and a simple. In order to do this, you need to be age 70 and a half. So one that is 70 cannot do it. I have to be 70 and a half, not the year you turn 70 and a half, but age 70 and a half. The maximum amount one can donate from that QCD is $100,000 currently annually. A married couple, also 100 each. It says 200, but it's 100 each. And if they were to do that, that has to come from their respective IRAs and distributed by December 31st of that year for the tax benefit. With the QCDs, recently, December of last year, a new law was passed, Secure Act 2.0, which hinges on the Secure Act of 2019, and it has a couple of notes for the QCD. One of those is, let me just skip those slides, didn't get to my point, is that the increase in the QCD for 2024. So for 2023, we stay at that $100,000 maximum, but for inflation, that is increased starting 2024. So instead of 100,000, that may go up to 6,000 in 2024. And also, there's a provision in the Secure Act that you can take a distribution from a QCD up to $50,000 and fund a new charitable gift annuity, which I'll mention in a moment, or a charitable remainder trust with that $50,000. And the bottom bullet point notates that it has to go into a new charitable gift annuity or a new charitable remainder trust, not existing. So as we saw earlier, charitable remainder trusts need substantial assets to fund. So in the infinite wisdom of Congress, I'm not sure what this provision really tries to accomplish, because I don't see many people doing that with a charitable remainder trust. However, that said, with a charitable gift annuity, which is in essence a contract between the donor or annuitant and a charity. So with this $50,000, for example, let's say with a charitable gift annuity, the donor or annuitant donated that 50 from the QCD to the charitable gift annuity. That is now a lump sum donation to that charity. Based on their age and that dollar amount, that donor will receive, a fixed dollar amount for their life, whatever that may be, and for lifetime, and on their death balance to charity. And so that's similar in vein to a CRT. It's a contract versus a trust, save or but for CRTs are much more expensive to fund than a charitable gift annuity. Moving on from those strategies, we'll talk about testamentary gifts. So testamentary gifts are those gifts coming that one may leave in a will or even in a trust to charity. So I've seen many clients leaving assets to charities in their wills. It can be as simple sentences: I leave, I bequeath, I bequest $10,000 to my alma mater or to my charity of choice. That is a charitable bequest in your will. So it can be a sum certain, a dollar amount such as $10,000, or someone can say, I leave 1/3 of my estate to the charity. So there are many different ways you can do that. A couple of notes here is that leaving those assets in or to a charity via a will. Depending on facts and circumstances, that will may need to be probated. And so there's a time factor there for that charity to receive those assets. And also, depending on the type of distribution, whether it's from a general, specific, demonstrative, or from the residue, are there assets to go to the charity? So just because it says it in the will, you have to look to see if there are enough assets to support that particular distribution. But also in terms of testamentary gifts, with those charitable trusts, so this person that has a will leaving those assets to charity, with those charitable trusts, they can be established during life or at death as part of that will in a testamentary trust. So once taxpayer donor dies and has a charitable remainder trust within their will, those assets go to the charity via, again, the language in that will versus that testamentary trust / charitable remainder trust. You can also leave retirement assets to the charity. So we see a lot of clients that don't have issues, don't have heirs, don't have family members. I have a few myself that have named multiple charities as beneficiaries of their IRA assets. It's as simple as the beneficiary designation form on that IRA. That person passes, the charity is notified. The assets will distribute to that charity. Income tax free, there is no taxation in terms of the charity or the person donating those at death. However, that said, those IRA assets at death are includable in the estate of that individual that died. Why? They were owners. They owned those assets at death. They had incidents of ownership. So they will be included for gross estate calculations on the return. But with that said, they'll take the unlimited charitable deduction, and so they'll benefit from that charitable deduction at death. So two ways to give it: death, testamentary gifts, and retirement assets. And kind of breezing through this, since we are on lunchtime, not a bad thing either. Life insurance. Life insurance is also a way to leverage assets to get to charity. So with life insurance, there are a few ways, but we'll note two. One is a simple, you name the charity as beneficiary, similar to the IRA. So I have a $1 million policy that has cash value. I name XYZ charity as beneficiary. I pass, assets pass tax-free to that charity, income tax-free, but also I own the policy. I'll assume I'm the owner of the policy. So as such, I have to include that policy in the estate calculation, but because, again, similar to the IRA, take the charitable deduction, no harm, no foul on taxes there. A couple of notes here on a policy that the charity is the beneficiary. The owner of that policy could let the policy lapse. So if I'm a charity, I'm not really counting on this until the check is cleared. Or I name someone else as a beneficiary. So you can do that, but there are caveats on that. Versus transferring ownership of an existing policy to the charity. So I have that same $1 million policy. I don't need the money to go to anyone. I'm charitably inclined. So what can I do? I can name that owner, get an assignment change of ownership form from the insurance company, complete that, assign it, transfer it to the insurance company. Now the insurance company is the owner. They can now change the beneficiary to themselves. They have options on what they can do with that policy. For purposes of this illustration, we'll say the policy is paid up, so they don't have to be concerned about who pays the premiums since they are now the owner. You know, if I still had premiums due, I could give premiums to the charity for them to pay. There are various ways I could get assets to the charity to make sure those premiums continue. But here, now they own the policy, and they can do what they will with it. So that's a good way to do it. And again, because I don't own it, policy is now out of my estate. And even though there are bullet points here, we'll briefly say that depending on the state, you can take out a new insurance policy and have the insurance company as the owner and the beneficiary. Caveat on that is the insurable interest. Typically, an insurable interest is someone that has an interest in you living and not dying. So I cannot take out insurance policy on my neighbor, but I can on my spouse, my son, my business partner, as that business partner can take one out on myself. We have insurable interests in each other. Depending on the state, most states have codified an insurable interest into the law for a charity. So typically a charity can be the owner on a new policy versus an existing, but you'd have to check with state law counsel, insurance company in terms of doing that. It looks like we may be getting towards the tail end and doing pretty good time, since you said about 45 minutes, and somehow I'm not seeing too many questions, but that's fine. They can always be emailed. So as you see, we just hit a couple of strategies here, but strategies that our clients employ, we advise on, are good for our clients tax-wise. They are charitable and great for the charity to receive those, especially if you're deeply involved with the charity. So I'd say if you're charitably inclined, you're looking to make donations, you don't know how, connect with an Atlas advisor, very well versed in these strategies, and it really should be part and parcel of an overall financial wealth planning, wealth transfer estate plan. I think we have one more slide where the QR code, yes, with our orange arrow. So if you see that, scan that. Again, there is, as Lonnie said earlier, there is a survey you can take if you care to. You can fill that out online and get that in however that gets in. I'm assuming you just hit the button, that PDFs, and we're appreciative of that to see what else we can offer in the future. So it looks like I may have a hand up for a question.
All right, we have one question. If my RMD is $26,000 and I gift $26,000 in a qualified charitable distribution, what are the tax consequences?
If your RMD is $26,000,
and I gift $26,000 QCD, what are the tax consequences, or who ate them?
So your RMD is 20. The RMD is 26, and you're taking and you're doing a 26 QCD, so that is a wash. So in terms of tax consequences, I'm just walking through this in my head. You have a $26,000 RMD, but you're not taking the RMD. You're taking it and donating that $26,000 to whomever charity. That $26,000 RMD is excluded from income. So there's not a deduction. That's an exclusion of income from that QCD. It reduces your taxable income. Those circumstances. Anything else?
Yep, there's another question. If I name a charity in my will, how am I or are they taxed?
If you name a charity in a will, how are they taxed? So again, there is an unlimited charitable deduction. So you name the charity, let me make a number up. You name a charity for $100,000 going to XYZ alma mater 501c3 charity. So that is a charitable contribution to that charity. They are a tax exempt organization They are not taxed on that. You as unfortunate deceased, but the donor, your estate is not taxed on that either. However, it's included in a tax calculation, but because there is an unlimited charitable exclusion, no tax. I think we may have time for probably one more.
You mentioned before that gifting stock is a great way to go about making a donation. If the charity sells the stock, is the charity taxed?
Charity sells the stock that you have gifted to it, are they taxed? Short answer is no. So that would defeat the entire purpose of that tax exempt organization. So that example where we use $50,000 of appreciated stock where we gift to the charity, I get the tax deduction. Charity now receives that $50,000. They sell it, no tax on the charity that sells. So that's a win-win for the donor and the charity. That's it. I appreciate your time, everyone, and look forward to seeing you next time around. Thank you for attending.